Hello and welcome to today's webcast entitled Expanding into Europe, How to Avoid Missteps. My name is Dominique and I'll be your event specialist today. We will be taking questions over the web throughout today's presentation. Please click the Ask a Question button, type your question into the open area, and click on Ask a Question to submit. If you should need technical assistance, please type your inquiry into the tech support box on the left side of your screen and click the Send button. Now, without any further delay, it is my pleasure to turn the webcast over to your first presenter, Dave Barry. Dave, the floor is yours.
Okay, well, thank you, Dominique, and good morning or good afternoon to everyone. On behalf of Dow Jones and our sponsor, Nair Co, I'd like to welcome you to what should be an informative discussion. Joining me today are four individuals with great insight on what it takes for a startup to successfully expand into Europe. Their views on what to do and not to do will hopefully provide guidance as your company looks across the Atlantic. With that, let me introduce our fine panel. First, providing us a view on important accounting and human resource issues is Sean Nair, co-founder of Nair Co, which services companies expanding abroad by providing an integrated solution for HR, finance, tax, and legal needs. Since founding the company in 1994, Sean has grown it to a global enterprise with offices in the UK, India, China, United States, Japan, and Singapore. Sean, could you say hello?
Hi there, everybody. Pleasure to meet you. Good morning, good evening, good afternoon, depending on your time zone.
Giving us one of our startups' perspectives is Andrew Snyder, Chief Financial Officer of Shooter CRM, a fast-growing business CRM company. Previously, he was CFO of Medallia and COO of Concentric Medical. Particularly notable to seminars that while at Concentric, he launched the company's international sales efforts. He also has been CFO at publicly traded Marimba and at Interstep. Andy, could you say hello? Enables enterprise open source adoption. Ken has more than 30 years of financial and operating experience. He was previously CFO of Salary.com, a company which he helped take public in 2007. He's also spent time at Mirrors Capital Advisors, Lodestar Corp, Student Advantage, MediaMap, Shoplink.com, and Liberty International. Ken, could you say hello?
Thank you very much. This is Ken Goldman, and I'm pleased to be able to participate in today's panel.
And I did mention that we had four, and we're still hopeful. James Kirkland, he's the Corporate Controller of Virtual Instruments, is on board to do this, so we're hoping he'll join us at some point during the event. Okay. So the aim of this seminar is to give you insight into what you should be thinking about as your company expands into Europe, especially given the headlines about the continent's economic situation. We are hoping to hit on some of the key issues, but we do encourage questions to be submitted online, and we will try to get to as many of these as possible during the hour. Grow and quickly. That appears to be the message that U.S. venture capitalists are giving to startups. Excited by the technologies being developed, U.S. VCs pumped more than $32 billion into startups last year. But they realize that if they are going to see a return on that investment, that they need those companies to quickly develop products and land customers. And to that end, that means that companies must move beyond the U.S. and look abroad. One obvious place, of course, is Europe, both because of its proximity and because of the common usage of English. The fact that European startups raised roughly a fifth of what U.S. companies did last year is another reason why the continent may be a prime place for U.S. startups to expand. But it is important, obviously, for companies to do such expansions correctly. Our aim today is to discuss some of the key issues and things that companies should be thinking about and considering in making such a move. So let's start, if we can, with some of the basic questions. And one of the key ones is, when is the right time for companies to expand into Europe, and how should they be thinking about the process of doing so? And Ken Goldman of Black Duck, let me start with you. How did Black Duck think about expanding into Europe, and what functions do you have over there, and what were some of the things that you gave thought to in doing it?
So it started with the market opportunity. The reality is that the U.S. market is our primary market, but as a 9-year-old venture-backed company, 45% of our business is done outside the continental United States. Europe, as you stated, was the most logical place to start, and like most companies, in particular East Coast companies, we started in the UK, both because of proximity and common language, but we quickly expanded to France, Germany, and the rest of Europe as we came to realize what an untapped market opportunity it was. The challenges, of course, are the things that we're going to talk about on today's call, but we found the European market to be one of our most important worldwide, and despite the current economic crisis, we're still finding significant pockets of opportunity.
Yeah, maybe it'd be good just to hit on that one point, because we're not going to dwell on it too much later in the event, but the economic uncertainty that does seem to be what, when you think of Europe these days, that's what you do think of. And Ken, you seem to indicate that it hasn't had much of an impact, or you haven't seen much, at least affecting your business over there?
So I guess on the spectrum of robust to non-existent market, I wouldn't say we're at either end of the spectrum, but we're still seeing decent returns from our investment in Europe, and we're still hiring employees there. We're still seeing growing sales in Europe. Is it more difficult? Yes. Are we more subject to the vagaries of the European economy? Absolutely. But large European companies are still continuing to do business, and if they're doing business and you have a solid case for a product or solution that provides a high ROI to them, they're buying. And so I'm pleased to say today that Europe is still open for business, and we're growing in Europe both in terms of headcount and the amount of revenue that we're generating.
Andy Schmeis of Sugar CRM, maybe you could give us your perspective, both from, as I mentioned, some of your past experiences, but also with what you've done with Sugar CRM, how you thought about going into Europe, where you ended up going, and then maybe you also could hit on the economic situation over there and how that played into what you're doing.
Yeah, sure. I joined Sugar CRM relatively recently, and it had been well established in Europe, and my experience here at Sugar is very, very similar to what Ken described, so I won't go through that again. At Concentric, it was much earlier in the process where you're actually deciding whether it's time to go to Europe or not. And at Concentric, as well as in my other experiences, the key, similar to what Ken said, is there sales? I mean, is there a real sales opportunity there? And if there is, then it makes sense, and it's not easy, and it takes some work. But if there's a sales opportunity, and usually there is, it's time to do it. And one of the questions I often get is, do you have to go first? Do you have to set up the ability to sell before figuring out whether there's a sales opportunity, or can you figure it out from here? And I believe you can figure it out from here. I think you can send people from here over there, spend some time, poke around, and they'll come back with a pretty good sense for whether there's a real opportunity or whether it's just a hope. And once there's a real opportunity, then you have to go after it. As to the question about the overall European financial situation or economic situation, we're an interesting business, Sugar CRM. We tend to play up and down the spectrum. We have lots of very, very small customers, and we're also selling into very, very large customers, and we've really seen a split. The small customers have not been impacted that we've seen. I think they see these as macroeconomic factors that don't necessarily impact their day-to-day decision as to whether to move forward with a solution. But the bigger customers take these macroeconomic factors into play and have slowed down a little bit.
Okay, very good. And Sean Nair, you've kind of heard from Ken and from Andy. Anything you would add just to sort of, as we get this going, in terms of how companies should think about just the first couple of steps, or just even think about going to Europe?
Sure. I think basically, just to recap on Andy and Ken, we have not seen any slowdown whatsoever in the amount of business that we're doing in Europe supporting clients. And in fact, a large number of our clients are expanding extremely rapidly in Europe, despite the current economic issues. So, Europe has always been a major continent for us. It gives us more than half of our business and has consistently done so for more than a decade. So we're not actually seeing any impact at all of the current economic issues insofar as our clients are concerned. Other than that, really, I don't have anything to say on this particular slide.
Right. So let's talk about expanding into Europe. You've made the decision to go there, and so let's talk about a few of the important issues related to how you were going to structure your operation. And Sean, maybe I can start with you. You can tell the audience some of the things that they should think about as they're considering making such a move.
Sure. The kind of one thing that a lot of companies do is to enter Europe on the cheap by hiring so-called contractors, but these contractors fail all the classic tests of self-employment. And Europe has the concept of deemed employment, so they basically can jump either way. They can, if they've not been particularly successful, and the company now wants to terminate the contract, they can claim deemed employment rights. And if the company then does not terminate their contract in the correct way, taking into account that they're deemed employees, then they can sue the company successfully in an employment court. On the other hand, if they've been very successful and they're salespeople who've been very successful, and let's say the company has been using a sales agent and now wants to insource it, but the sales agent doesn't want to give up his independence and join the company, so the company terminates him. Under the European agency rules, they're entitled to compensation for loss of goodwill of the business they've generated, and that can be a huge sum. There have been companies, to my absolute certain knowledge, that have ended up shelling out more than $1 million of compensation under these agency rules to successful sales reps who have sued them following a termination of their contract. So although contractors may be a convenient way of entering Europe, it's a very short-term solution, and it's one that's loaded with dangers if you continue with that type of arrangement for more than, I would say, a maximum period of about 3 to 6 months. A much better way is to employ them in a short-term employment contract, but it is important that you take advice. For example, in the case of France, if you have an employee on a short-term employment contract, you have to have a business case for it, and you have to factor into your budget that at the end of that 1-year period, you will have to pay him an additional 10% lump sum of the salary that you paid him for that year. So it's important to get expert advice before you enter into these situations. I think that's all I would want to say about contractors. But Ken, maybe you've got an insight into this you might want to share?
So first, an overarching theme, and that is the difficulty for companies based in the United States doing business abroad, especially what I'll describe as development stage or growth stage companies. Large multinational companies don't have this problem, but smaller emerging growth companies have this problem, is you don't know what you don't know. And, although Andy and I have both done business abroad, and I've done business in probably 24 or more countries, I wouldn't claim to be an expert. And the scariest thing is what can trip you up. And you just gave an example of, deemed employment laws. I've seen it happen too many times where you go to fire somebody and you find out that, for instance, in the Netherlands, you can't fire somebody. The courts have to agree to allow the employee to leave your employment, even if you're willing to pay them a large sum of money to go away. But both in my current employment and in prior companies, and in the interest of full disclosure, before I got to any of those companies, there was always the approach to, let's do it the cheapest way, because in theory this works in the U.S., so why shouldn't it work in Europe? And so, the concept of, well, we'll just engage somebody in an arm's length contract to do work for us. We'll state explicitly that they are not an employee, and we should be fine. And while that might work perfectly well in the U.S., what you find is that because there's a different system of laws, there's a different history of regulations, you can find that irrespective of the contract that you've engaged this individual in, that you are tripped into an employment relationship that is the gift that keeps on giving. And as you stated, Sean, the risk in particular with salespeople is that they can continue to claim commissions from now until the end of time, even if you want to get rid of them and even if they weren't performing. So the scariest thing for me, as I go back to the overarching theme, is the risk of not knowing a specific law, specific regulation, the place where you can get tripped up.
The other kind of banana skin is VAT. So, for example, when work is done, chargeable work is done in country in Europe, that attracts VAT. And essentially, that then leads to a whole chain reaction. Because if your part of your revenues attract VAT, then you have to invoice for them through a VAT registered entity. If you've got to invoice them through a VAT registered entity, that affects now your tax structure. It affects your intercompany agreement, and even more to the point, it affects your contract of sale. So there's a kind of chain reaction working backwards from VAT. If a company ignores that and generates VATable revenue and just invoices from the U.S. without registering any of the invoicing entities for VAT, the risk is that when your customer has a VAT inspection, and if you're unlucky enough that they pick up your invoice and inquire further, they could come and cream off. For example, in the UK where the VAT rate is 20%, they could cream off 20% of the sales that you generated in the UK, which, taking into account that this sort of thing can happen like 4 or 5 years down the line, could lead to a very substantial liability. So VATs, I would say, it's a very wide-ranging area, but it's an area that you have to get right. And again, you do need expert advice that's country-specific to actually make sure that you're structured correctly. The next area, I think, is for certain types of companies, particularly, say, companies setting up server farms in Europe or owning goods that are kept in warehouses for logistical reasons. It's very important that the U.S. does not acquire a permanent establishment in Europe, i.e. a local country taxation exposure. And it's very important, therefore, that the structure is set up in such a way that that type of exposure does not happen, and in particular that the U.S. does not directly own revenue-generating assets that are held on European soil. The Netherlands also has a lot of advantages of, having focused on some of the risks. Let's focus on on one of the advantages. Netherlands has got a very convenient VAT contra-entry system where you pay and reclaim VAT on the same form. So if you've got enough throughput of goods, it may be more cash flow effective for you if you imported all your goods directly through the Netherlands and then routed it through Netherlands en route to your customer rather than directly to your customer. However, again, there is a rule in the Netherlands that you have to deposit 25% of the VAT payable. If you're using a fiscal representative to clear the goods, you have to deposit that 25% with the customs and excise in Netherlands. So there is a kind of cost associated with it, although it looks attractive, and it is attractive, there is nevertheless a kind of cost associated with it. You only get that deposit back if and when you stop shipping the goods through Netherlands. Last but not least, it's very important also that you keep abreast of changes in tax regulations, not just the regulations per se, but the way in which they are interpreted and imposed. A good example is Germany, where regulations themselves haven't changed, but the Finanzamt these days in Germany will seek to tax a reduction in value of a German subsidiary like a GmbH if there's been a transfer of function from the GmbH to another country. So let's say you had a VP of Europe based in Germany who resigned and you replaced him in the UK. That would be deemed to be a transfer of a function on which the Finanzamt would seek to tax the assessed loss in value of the GmbH. The reverse does not happen. The UK's HMRC will not seek to tax any reduction in implied value of a UK limited company if a VP resigned in the UK and was replaced in Germany. But it's not it's important that you take into account these types of issues. You know, the issue here is not a change in the law, it's a change in the way in which the tax authority is interpreting the law.
Andy, do you have any thoughts on any of that? Anything that's any good, bad that you give thought to when you're?
Well, yeah, Shan is clearly scaring me out of Europe. It is complex. You have to stay in touch with the rules. You have to have local advice. You can go country by country to get that local advice, or you can work with someone like Shan who can provide universal advice around the different countries. It is complex, but it's very overcomable. The trip-ups are when you don't pay attention. If you think you have it set up and that 6 months later it's still going to be set up and running smoothly, that's not the case. You just need to pay attention to it and understand, like I believe Ken mentioned, that you don't know what you don't know, and there's nobody out there whose job is to go tell you what you don't know. So it's difficult. It takes attention, but it's very doable.
Is there anything that still sticks out in your mind, either from your past experience or even current, that has you double check and make sure that something has been taken care of, or that you don't do that again the next time you go into a country or you set up an operation?
Well, Shan talked about contractors and the risk around them, and I would take the same point and broaden it, which is that all of your investments in Europe, particularly when they're around people, you just have to think of them as having a much longer tail if anything goes wrong than anything you're used to here in the U.S. Whether they're a contractor, whether they're an employee, everything will take time. Hiring will take time. Firing will take time and cost money. So to a certain extent, if you're capable of it, it's great to take your time and think it through before you make moves, as opposed to, what often is the case, which is, hey, we found the guy we want to hire. He happens to be in this country. Can he start in 2 weeks? That's when you make your mistakes.
Ken, anything else that you would add?
Well, so let's start with the idea that it's such an incredible market opportunity. I mean, we truly live in a global world today, and so you can't even think about a U.S. company selling to a company in Europe, because you then have to think about the fact that that company in Europe is selling potentially to the U.S. So the reality is that if there's a market for your products in the U.S., there's probably a market for your products abroad. You just have to figure out how to tap that market. The challenge, of course, is that, to some extent you're a kid in a candy store, everything looks good, but the problem is that trying to manage all of the complexities, the degree of difficulty is multiplied by an accelerated factor by virtue of the fact that you may think you know what you're doing in the four walls of the United States, but when you go to Europe, it varies by country. It varies by, are you a branch or are you a subsidiary? So there are tax considerations, there are legal considerations, there are HR considerations. And, the problem is one little mistake can be very expensive. And what I will tell you is hiring the right advisors is what I refer to as sleep well at night insurance. Going back to what Andy said and what I said, you don't know what you don't know. The potential problem where you get a letter from some governing authority in Europe that says, okay, we've decided that you do have a permanent establishment here, and therefore we want to consider everything that you've done since the first day you stepped on our soil. The challenge, of course, is that, for instance, some simple things like, as a U.S. company, I'd like to bill in U.S. dollars. I'd like to have the bill sent from my entity in the United States. I'd like to collect the money in the United States. But there are other things that you have to take into account which add to the level of complexity in terms of currency translation and the risks associated with doing business in multiple countries because of tax things. There are instances where, for instance, with regard to taxes, where you may be subject to a withholding tax even though you're not a taxpayer in that country, and therefore it becomes a reduction in the amount that you're getting paid if you don't have the right tax setup. And so you can lose anywhere between 5 to 25% of your sales just because of the tax inefficiency if you're trying to do something that seems simple but it's not.
John, we had a question that I think it actually works into the next slide as well, because talk a little more about employee side of things here, but a question to one of your comments. They want to know if you can clarify whether short-term, 12 months or less, employees in a country such as France can be hired through the U.S. parent or require a local entity?
That's a very good question. In fact, France is fairly unique among the European countries in that a non-French company cannot hire anybody in France, short-term or long-term, without establishing an appropriate registration. So the French have 3 levels of registration. They used to call the lowest level a bureau de liaison. That name is officially does not exist anymore, but that type of registration and the procedure that you go through to get it does. Then the second level is a branch, and the third level is a subsidiary, and there are 4 different tiers of subsidiaries. The EURL, which is a single shareholder entity, the SARL, which is a multi-shareholder entity, an SA and an SAS. And you can upgrade from the URL all the way up to SA and SAS. The answer to the question really depends, what type of entity, really depends on the job title, job description, and the relevance of the activities of the individual concerned to the core activities of your business. So if the activities are not core activities of your business, let's say that you don't have material sales in in France, that the employee is involved in marketing, administration, and fringe type activities of your business rather than core activities of your business such as sales or customer support, then you may be able to get away with the bureau de liaison type of registration, at least until your headcount reaches a couple of employees and stays at that level. So a lot depends on your specific circumstances, but the fact is that a foreign company just can't go into France and just hire somebody without doing something that's France-specific to enable them to do that.
So another question that came in sort of related to just what you just said. At what point, number of employees do you need to establish work rules or a handbook in France and Italy?
Actually, in France and Italy, the employment liabilities are very high, and also there are some contradictions in the law. So, for example, under Italian employment law, you cannot stop an employee in Italy from accepting a gift from a supplier, but that could be construed as accepting a bribe in certain situations. It will be a breach of FCPA. So I think it's actually very important, even at one employee, that you establish a clear-cut work rule. You might choose to do that at one employee rather than produce an entire handbook. You might choose to do that in an employment agreement that's extended. The risk of that, the advantage of doing that is that it's a lower cost than employing a handbook when you start. The risk of doing that is that you've now legally hardwired yourself into terms and conditions that you may then have difficulty subsequently changing. Whereas if they'd been in a handbook, it's non-contractual. So you can actually have the flexibility of being able to make those changes as your operations in those countries expand. So again, I would argue that at what point? Well, the point I would say is one employee, but how you do it and what you do it will depend very much on your sales, on your prognosis for the growth of your operation in that country. Also in France and Italy, and this actually brings me to the CBAs, both these countries have something known as the collective bargaining agreements, which set floors on the benefits, minimum benefits that employees are entitled to. The CBAs are basically industry sector and are negotiated countrywide between the unions and the government. And they basically therefore are dependent on the industry sector into which your business falls and also into the grade of the employee. For example, if you take France, there are 3 levels of seniority. They're known as the cadre dirigeant, 1, 2, or 3. Most U.S. companies would employ people in number 2 because in number 1, although the regulations governing the hours of work, etc., are very open, the cost of terminating a senior employee is very high, so you wouldn't want to classify them as 1. While on number 3, you have they're basically like blue-collar employees, so you've got to have timesheets and timekeeping, and the overtime administration becomes a bit of an overhead. So normally you would classify them as number 2, where they're not that senior that it's prohibitively expensive to terminate them, and they're not that junior that you have to keep detailed timekeeping and timesheets. So again, the solution that you would go for would depend very much on your circumstances and has to be tailored. There isn't a cut and dried answer. I think this question very neatly also covers the employment contract or staff manual issue. That's tied very closely to the number of people you're going to hire and the severity of the employment laws. Because a staff manual, which is European speak for employee handbook, will have in it sections dealing with disciplinary procedures and grievance procedures. And by getting the employee to sign on to those disciplinary procedures right at the start of their engagement, if thereafter you end up in an employment court, the court will not look at whether your procedures were appropriate or not. The court will take the view that the employee signed on to them and so he's bound by them. The court will therefore only look at how you applied them, whether you applied them fairly or whether there was a discriminatory approach. So your risk of incurring damages and significant damages if the employee wins are kind of halved. However, there is a higher initial setup cost because it costs a lot more to prepare an employee handbook than it does to prepare an employment contract. So you're again into balancing risk and cost, and the right balance, there's no prescriptive answer, depends on the scope and activities and the expansion plans of your specific business in that country.
So Andy and Ken, it'd be good, there was another question that tied into this as well, was most favorable European country from a labor and tax perspective. Do you have a favorite, Andy?
The UK is always easiest, not because it's necessarily the best from a market standpoint, but it shares a lot of law, and the labor regulations are different, but it's much more similar than it is to the U.S. than countries on the continent. So, you know, if you're going to go to one place, that's sort of my default, unless the market takes you somewhere else. After that, Germany really is the sort of lion from a market standpoint, and they have a, you know, good, solid Germanic set of rules that at least can be understood. So I would say UK and then Germany.
What's the worst?
Well, you just avoid the South without calling out any names. I mean, Shan touched upon France, Italy. Those places are very, very difficult to navigate. However, they're also very, very difficult to sell into without a local presence. So that's a trade-off you have to make, and eventually you make it. So every company I've been at 3 now with significant European operations, and in every one of them, you end up in France eventually.
Ken, did you have anything to add to that?
Well, the only thing to add, and I'm not sure, maybe Sean can expand on this a little bit, is the ability to go into one country and do business in the next country. So, for instance, when we went into Europe, we established a European holding company in the UK, and we were able to jump from the UK to some of the bordering European countries without having to necessarily establish a presence in those countries. There is an enhanced level of complexity, and you can only do it for a short period of time. But and I don't claim to be an expert here, but you can, if memory serves me correctly, you can have one European country held by another European country's operations and avoid having to increase the level of complexity because you already have a presence there and a permanent establishment. Sean, maybe you could add a little bit more on that?
Actually, there is a relatively recent and not heavily used, and I don't really understand why not, option called the European Limited Company. The European Limited Company, the advantage of the European Limited Company is that you can, it has to be headquartered in a particular European country. So it's got to be registered in a particular European country, but you can change its registration from one European country to another without incurring the kind of risks that transfer of function type costs that I alluded to earlier that happen in Germany when a function is moved. And so this European limited company can move its registration from one EC country to another as and when the central gravity of your business moves around. it's a concept and it's an option that exists, but to my knowledge, not many companies are using it, although it's there and available. And I think it's something that may be appropriate in the right circumstances.
I'm going to move to the next slide. So, Sean, you want to?
I will try and do this as briefly as possible. I think we've already covered the issue of balance and cost and risk, when answering that one of the prior questions. It's a question of do the job titles, job descriptions, the materiality of the level of business that you are generating in a particular country, do all of these allow you to set up a non-taxable type of registration, like a place of business, a bureau de liaison, rep office? It's all the same thing, basically. It's just called different things in different European countries. And how long can you operate that way? Because while you operate that way, you don't pay any corporate taxes. However, you do have to be a little careful about how you structure this, because you could get bitten in the butt later. For example, if you made out a case to have somebody in one of these type of registrations initially, and you'd said that that person's role was to basically identify, record, and feedback to US R&D all of the customizations required in your product to enable you to sell it in their market, that could be used as a reason several years down the line when you have a successful business in that country to argue that you've generated some country-specific IP in that country, and that therefore that country's tax authorities are entitled to have some of your IP licensing fees allocated to that country. That in turn could mean that you now are forced to show a large profit in that country on which you may have to pay taxes. So you have to think ahead and determine, how is my business actually going to grow? Is it actually advantageous for me to take this cheap initial way in? Or is it better for me to bite the bullet and take some higher cost now, because by doing that, I'm going to avoid the risk of incurring much higher tax charges later. We all know about how you structure a business once you're cash flow positive and you've used up your net operating losses. You probably won't want to book your revenues here in the U.S. because this country, after Brazil, has got one of the highest rates of corporation taxes anywhere in the world at the moment. So many companies will, by the time they get to the stage, have moved their IP offshore to places like Cayman and will be setting up regional profit centers in countries like Ireland, Switzerland, or Hong Kong. In the case of Europe, the advantage of Ireland is that it's got a very low rate of corporate tax for a headquarters company, but the headquarters company needs substance, i.e. needs feet on the street. In the case of Switzerland, it's important that you choose the right canton, because cantonal tax rates can vary substantially. I was looking at this the other day, and there is a factor of 2 difference between the overall tax rate you pay in Switzerland for the lowest tax canton compared to the highest tax one, which is in Geneva. Having said that, Swiss regulations do not require you to have substance, but increasingly the IRS is looking at arrangements of that type and disallowing them. So it is important that when you restructure, you don't just do it to save tax, that you actually tie it into a general restructuring of your business so that the change can be presented as part of an overall series of changes that you're implementing in your business because your business has crossed a watershed. I think in Eastern Europe, I can make a few general comments in that I would classify the Eastern European countries into 3 boxes. The new ones that have basically switched and are really behaving like any country in Western Europe, the ones that are changing, and the ones that are still traditional old style. So the new ones really are Czech Republic and Poland, where rules and regulations are very clear-cut, straightforward, and really no different to operating in countries like Germany or Belgium. Then you've got the changing ones, typical example is Slovakia, which originally was very old-style, pre-communist kind of approach, which is adapting rapidly to becoming a capitalist Western-style type country, and the laws and regulations governing setups, tax, compliance, etc. are also changing with the bureaucracy reducing. And then you've got the old-style countries like Romania or Belarus, where the regulations are very stringent. It's very difficult to do business. For example, just getting money into a bank account for the first time to pay your employees in Romania is not an easy exercise. There are a lot of hoops you have to run through, even after opening the bank account, to actually get the money in there. So I think that's all I would say. The rates of tax in some of these East European countries like Romania are very low, but how stable that situation is going to be is difficult to tell, and is probably doubtful. So I wouldn't recommend any client set up a European headquarters in Romania or Belarus at the moment just because of the rates of tax.
And kind of got into the cost and risk analysis there. Can you talk a little bit about how Black Duck thought about that question, and then I guess also we've hit a little bit about locating operations, but maybe how Black Duck has tried to run its operations over there?
Well, so you're getting into an interesting point, which is something we haven't talked about yet, finding really good people. The challenges of hiring good people in the U.S. Are problematic. In Europe, it's amplified by virtue of the fact that you may be meeting somebody first through a recruiter or some other introductory source, and you're going through the hiring process, and you may not get to spend as much time with them. You may not get as forthcoming references on a candidate, and so the challenge of hiring good people and then trusting them to work remotely, again, just adds to the problems of doing business internationally. As to where we chose to locate our business, it was where the opportunities were. Very simply, we have people on the ground in France, Germany, the UK, and the Netherlands, because those are the areas that we saw the most opportunities. But we are doing business in adjacent countries when necessary, or when the opportunity is there. It's just a question of Europe's complicated. There's a lot of different places we'd like to go. In some cases, we're going through channel partners because we've just said the cost-benefit of establishing feet on the ground in that location doesn't make sense at this point in time. And as Andy will tell you, the problem is when you go through channel partners, what you eliminate in complexity, you give up in margin. And so the problem is that while you want to go direct wherever you can, you may not be able to do that for a host of reasons. For us, with regard to the profit centers and what Sean talked about before with regard to locating IP, we're now at the stage that our European operations are mature enough that we have to start thinking about doing business in local currency, doing contracts in country, location of IP so that we have more advantageous tax positioning, and trying to eliminate some of the complexity that we've been willing to deal with when we were smaller, but now that we're growing, we need to eliminate.
Andy, anything to add to that in terms of how Sugar CRMs looks at operating in Europe?
No, I can hit it right on the head. You follow the money, and where there's opportunity, you first say, can I monetize that opportunity without putting feet on the ground? Because if you're only in 5 countries, you have 5 headaches, and if you're in a 6th country, you now have a new set of headaches. So he mentioned how you start in the UK and you sell to everybody else. That's exactly how he did it back in Marimba 10 years ago, and it works until you run into a situation where there's enough opportunity in France that you have to put somebody down in France. So you try your best to keep it under control. And right now, Sugar CRM is very similar to what Ken describes. We have a headquarters in Germany, we have people in the UK, we have people in France, we have people in Sweden, and we have people a large contract, not direct employees, but contract organization through Belarus, as much as Shan cautions us, and correctly so. We're finding a ton of engineering talent there, so we've been compelled to go there. But the end answer is I think Ken said it exactly right, which is you have to end up following the opportunity.
Okay. We're getting down. I want to leave some time for go through some of the additional questions we've had come in here and take some others. But one of the key things, communication, setting up an office. How do you manage staff and make sure everything's going well? What structures work? What don't work? And how often should the U.S. executives go overseas? Andy, any thoughts about that? And since you mentioned you do have these various outposts over there.
I think this is one of the most important points, and I can't emphasize enough how important over-communication is. I mean, the things that you would take for granted over here because you have a general understanding of how things work, you can't take for granted over there. When I've seen this work, I would be on the phone twice a week with the guy who ran Europe, and we'd talk about everything. Who's doing well, who's doing poorly, how's recruiting growing. That lifeline between headquarters and the European operations is absolutely critical. I've also been in situations where the reverse is true, where you end up with a very strong general manager running the non-U.S. Organization, and there's not as well tied together, and that's just very, very difficult. So I'm a huge believer that the communication is absolutely key, and as many times and in as many ways as you can foster that, whether it's trips, whether it's having, at Sugar CRM, we don't have a sales kickoff, we have a company-wide kickoff, and we send everybody worldwide over here to get them together. I just think that's very, very important.
Ken, anything that you've learned?
Actually, funnily enough, I'd like to just answer this one from looking at Nair Co itself, because we look like our clients. We've got offices all over the world. I can't agree more with the comment that you can seriously under-communicate, but you can never over-communicate when you're in multiple countries. Most of the time when a problem arises, it's as a result of a disconnect arising from a lack of communication. And one of the things that I emphasize internally in our staff, to our staff, is don't keep on emailing clients. Pick up the phone and call them, because you'll achieve more in a 5-minute phone call than you will in about 5 email ping-pongs.
And Sean, if I can add to that, one of the things you have to think about if you're an American-based company or if you're a U.S.-based company is time zones. So we're particularly adept at paying attention to not always doing a call or a webinar or something that's at a convenient time for those people. We're in the greater Boston area who are located in Boston. So I do a lot of calls at night and early in the morning, because if I've got somebody who it's the middle of their day, I've got to be respectful of their time and not say, well, I'm going to do the call at noontime and, forget about your plans to go out to dinner with your family. The reality is that there's a give and take, and if you try to enforce we're a U.S.-based company, therefore we're going to go from U.S. time zones, that only adds to the problem of distance. With regard to the question of how often should you go overseas, as often as your travel budget allows, but we in particular have each executive in the company traveling on a regular basis, so they're not just seeing the head of sales, they're seeing me, they're seeing the head of product, they're seeing the head of strategy, so that they feel that not only is headquarters there to support them, but that they don't feel like an outpost. Because if you're going to hire good people and you're going to try to keep them and you're going to try to make them productive, they have to feel like part of it. And what Andy said in terms of getting everybody together, a minimum of twice a year, we bring all of our employees together worldwide, and it's both for business and for social reasons, because we want to enforce or reinforce that connection so that the people who are not based in the U.S. don't feel like they work for a different company.
Right. Sean, we have just a couple minutes here to get through this, but you can give just some quick highlights related to accounting issues. I don't know if that's possible, but maybe you can try anyway.
I'll try. I guess most of it is pretty clear-cut and fairly obvious that if you're in a country, you must be aware, even if you're relying on third-party service providers, you must be aware of what all your key filings are. I would argue it should be not just all important filings, but each and every single filing and its deadline. There are certain filings like statutory accounts filings in local GAAP at year-end where the U.S. may have some of the information that's required. For example, detail on intercompany transactions is a good example, without which you can't finalize a set of statutory accounts. So it's very important that the service provider is not just relied on, but is actively managed by the U.S. to ensure that essentially the filings, once they're prepared, are prepared on the correct basis, and that there isn't any disconnect in understanding between the U.S. and the local country service provider. The running of payroll and maintenance and management accounts, the main time we've come across a lot of problems when we pick up payroll type situations is that the handling of equity compensation related issues in the payroll has been mishandled, and that can give rise to substantial liabilities. So for example, in certain countries like in Europe, taxes are due on stock options on grant. Now, if factors like that have not been taken into account, then the company could be non-compliant. And I think that is the one major kind of banana skin, if you like, that exists when payroll issues are picked up. The associated filings, obviously, once you prepare the local GAAP accounts, there are corporate tax filings to be made. There may be corporate tax payments to be made on account. If you have a substantial European operation, you will undoubtedly have a need for provisioning calculations, corporate tax provisioning calculations. But these are all pretty standard things that any competent service provider in country should be able to deal with. Your main issue, I think, when you're dealing with multiple countries is that you don't want to be in a position where you're dealing with multiple service providers on different topics in different time zones. You don't want a payroll company, a compliance accountant in each country. Multiply that by 5, you may be into about 8 to 10 different service providers, and that becomes a huge headache. You also lose track at that point of international perspective. And I think it's very important when you're in that situation and where your operations are not large enough that you can insource these functions, that you actually use a service provider who's got an international perspective, who knows on what issues the French and German tax authorities are passing information to each other about, and therefore you need to watch out and warn your client and work with your client to avoid, and on which issues you don't have to worry about things like that. That's the main point I would make.
Okay, no, that's good. That's good. All right. So maybe we get another thing to think about, but I guess first like just get into some of the questions that we had here. There was one question that came in about when you brought up about the European LTD company. Is it one entity that can cover multiple countries at the same time, or an entity that only covers one at a time but can be moved around?
The entity covers multiple countries at the same time, but obviously the entity has to register to do business in the multiple countries and has got to register for payroll and will have to pay corporate taxes on profits it makes in those countries. But it's one entity. The main point, the main advantage, the European limited company sounds very attractive, but it doesn't really reduce the amount of accounting and compliance support work that you have to do. The main advantage it's got is that if a function transfers from one country to another, it puts you in a position where you're not exposed to a tax charge. Unlike the case where if a function transfers from a GmbH to a UK limited, you are exposed. Unfortunately, and I would love to be able to tell you that there is a reduction in the level of compliance and accounting support, unfortunately there isn't, because the European Union the EU gives out all these great ideas, and then every European country goes and translates it into legislation in a different way. And so really businesses are left with a wonderful idea, but the way it's been effected, there really isn't going to make life easier for them at all. As I say, there's one advantage, and that's about it.
Right. Ken, let me ask you this question. Came in. When it comes to legal advice, are you better engaging a national, local law firm versus a single international law firm with local presence across the EC countries? Any thoughts?
There is no right answer, actually, and I don't mean to make this a commercial for Nair Co, but having been a client of Sean's at 4 companies now, I think it is, Sean, the reality is a lot of times I will get non-binding legal advice from my service provider and then determine whether or not I want to double-check that against either my international firm based in the U.S. or a local firm. The problem with local firms is sometimes the challenge of trying to communicate with them and trying to find the right local firm. On the other hand, many international firms based here in the U.S. or with a large U.S. presence are oftentimes working through partner firms anyway. A lot of times your best recommendations come from your peers in the industry who will tell you, okay, this is who's the best firm to work with on tax or legal or employment issues. But again, not to make it a commercial for Nair Co, having a firm that can help you on legal, tax, HR, and accounting issues is probably, as the expression goes, one throat to choke.
Andy, question about knowing about the opportunities in Europe, and the question, what tools do you use to assess this? Is there anything particular that you've learned, and whether it's a go or no go, or is it just talking to customers and that's the extent of it? Or
yeah, for each of us it's going to be different, and it's the same tools you use here. I mean, the rules are different, and the accounting is different, and the employee practices are different, but the customer need and the value that your product brings really isn't that different over there. So the same tool you would use to sniff out whether an account is a real account or not here in the U.S. Can happen over there. Over there it might happen over dinner versus over lunch over here. But at the end of the day, sniffing out the opportunity isn't that different.
Okay, and I think this is probably one of the last questions here. Should we grant options while country manager is in U.S. or home country? Is there tax implications?
Only, if I can just jump in there, only in the context of you're being in a situation, if you're in a situation where you're moving an expat from U.S. to that country to be the manager there, then there would be, otherwise there wouldn't be.
All right, and then maybe this last one here. The company plans on opening an entity in the U.K., hiring one salesperson, wondering if the U.K. entity has to book some of the sales, or if we can just continue to have the U.S. office book all sales from all countries as we do now. Any advantage one way or another?
Yes. If you've got usable net operating losses and usable by IRS rules, so you've got to check whether there have been any significant changes to your capital structure, say through a refinancing that might restrict or stop you from using your net operating losses. Assuming that that is not the case, then it is in your interest to book the foreign sales here in the U.S. until you've used up your NOLs. At that point, you would put the UK company into a cost-plus mode. So the UK company's role would be to prospect for leads, find the hot leads, introduce them to the U.S., but the U.S. would then conclude the negotiations and contract with the customer. Having said that, going back to my earlier VAT point, if one would need to dig into what type of services you provide to establish whether or not there is a potential VATable revenue stream. If there is a VATable revenue stream, then the easiest and quickest thing is to book that in the UK company and to amend the US-UK intercompany agreement to allow the UK company to do that. So you may have, say, a product offering that's 90% non-VATable, 10% VATable. So you stick the 10% VATable through the UK and recognize the other 90% in the US. That would in turn mean that the US contract of sale would have to be amended. It would need to have an appendix where the customer accepts that all of the VATable services will be billed to him by the UK company, because otherwise you can't legally do it if he objects. But we need a lot of drill down, but that's an answer in a nutshell.
Okay, all right. We're going to have to...
I'd like to jump in on that one. I mean, everything Shan said is exactly right. But for a little context, for those of you who are new to expanding to Europe, I've never been at any of my companies where we set up anything other than a cost-plus structure. You have to get to a certain size where dealing with the international income tax issues, I mean, Ken mentioned that Black Duck is just starting to get there. We are just starting to get there, and we have 35 people and half of our business is over there. When you're first getting started, I have yet to find a single scenario where cost-plus isn't the simplest, easiest to get started. I'm sure Sean has examples of that, but in my little world of Silicon Valley and startup companies, it almost always starts as cost-plus, where the contract isn't through the subsidiary in the UK. You do your best to maintain all of your revenue through the US.
Yeah.
Okay. So we're going to have to leave it at that. I want to let the audience know, I had a few questions about this, that Nair Company will be sending out a copy of the slides and a link to view the webinar, so in case you want to hear it again, or if there were people on the who did not get a chance to listen to it. They'll also be sending out a very brief evaluation form. If you could fill that out, that would be appreciated. I want to thank all of you for listening in, and I want to thank our panelists, Andy Schmeis of Sugar CRM, Ken Goldman with Black Duck Software, and then Sean Nair with Nair Company, and thank Nair Company for their support of the event. And with that, I will turn it back to Dominique.
Thank you to all our participants. We hope you found this webcast presentation informative. You may now disconnect.